As is often the case at the turn of a month, fresh data on the US economy will be the centre of the macroeconomic stage. Two items will be of particular interest in the coming week, especially in the context of the US Federal Reserve now saying that inflation rather than jobs is its primary source of concern. The first is the Case-Shiller House Price Index on Tuesday the 29th of March. The second is the latest batch of jobs and wage data from the US Bureau of Labour Statistics, due on Friday the 1st of April. The S&P Case-Shiller House Price Index hit a new all-time high in December with a 0.9% month-on-month gain. The reading of 278.6 represented a year-on-year gain of 18.8% and meant that the benchmark stood no less than 51% above the pre-financial crisis peak of summer 2006, a mark that many thought we might never see again. Now, if you want to find a case where ultra-loose monetary policy from the Fed has stoked inflation and price increases, well, then you probably need to look no further than this. The question now is whether the US Central Bank's first interest rate increase since 2018 will start to cool the housing market. The 30-year US mortgage rate now stands above 4.6% for the first time since late 2018, and you could be forgiven for expecting that that could put the squeeze on buyers who are having to really reach to buy their target property. You can already see the effect of rising mortgage rates on the sale of existing homes, which have fallen year on year for 7 straight months in America. It now remains to be seen whether that trend starts to weigh on house prices. In terms of the jobs numbers, the key figure may well be wage growth, given the Fed's newfound, if potentially belated, conversion to the cause of fighting inflation. Remember that last time around for February, the headline figures were the addition of 678,000 non-farm payroll jobs, an unemployment rate of just 3.8%, and year-on-year wage growth of 5.1% to an average of just above $31.50 an hour. A lot of attention will naturally fall on the headline jobs figure, where the new monthly numbers and any revisions to the previous ones will be important. Remember that upward revisions tend to incur during economic upturns, downward ones during slowdowns and recessions. But the wage growth number may be the one that the Fed's watching particularly closely, as Chair Jay Powell and the other members of the Federal Open Markets Committee prepared for their next policy meeting on the 4th of May, when markets are currently split almost 50-50 on whether the next rate rise will be 1/4 or 1/2 of a percentage point. By the end of this year, markets are looking for a Fed funds rate of between 2 and 2.5%, compared to the current 0.5%, and red-hot wage growth that would be a concern for policymakers. In terms of company news, there's just one statement scheduled from FTSE 100 firms for the coming week, but there could be unscheduled ones, and there are plenty of first half and full year result statements due from mid and small cap companies. Names which may be worthy of further study because of what they say about themselves, their industry, or the economy more widely include the following, although some of these dates could yet be subject to change. Pershing Square on Monday the 28th of March, IQE, S&U, Animal Care and Burford Capital on Tuesday the 29th, AG Barr, Michelmersh Brick and Inspired on the 30th, James Halstead, Mears, Provident Financial and Chesnara on the 31st, and Medica and Renew will round off the week on Friday the 1st of April. But the company which could just cause the biggest fuss in the week ahead is house builder Bellway. The FTSE 250 index members due to release first half results for the 6 months to the end of January on Tuesday the 29th of March. Now the shares are trading a lot closer to their 12-month lows than their 12-month highs, owing to worries over rising interest rates, the end of the stamp duty tax break, the narrower scope of Help to Buy, the imminent cladding tax on profits, and the overall impact on consumer confidence of rising fuel and food prices. Increased wage and materials costs could be a further factor, as even a very upbeat trading update from Jason Honeyman, chief executive, back in early February, didn't generate a lot of support for the shares, at least initially. Now, that update was quite detailed, so the first half results themselves may not feature too many surprises. Analysts and shareholders will therefore be looking more to the outlook statement for the rest of 2022 and beyond when it comes to 4 key numbers. The first is completions. Bellway's already revealed first half completions of 5,694, a 1% advance on the prior year, and actually a record for the first 6 months of a year. The company's target is to increase output by around 10% this year to about 11,000, before another step up to 12,200 homes in the year to July 2023. Bellway's long-term plan is 18 to 19,000 completions a year. Second key number is pricing. Mr. Honeyman has already noted a 3% increase in average selling prices in the first half to just shy of £312,000, and his forecast that the full year average will beat last year's £306,479. The third key number is operating profit. Most of Bellway's peers have flagged cost inflation in the range of 5 to 6%, but they have added that price increases have generally offset that. Bellway has a target of an 18% operating margin for this year and 18 to 19% in the medium term. And the fourth key number is cash. Net cash is around £196 million according to the last trading statement, and that cash pile, as well as future profits and cash flow, will fund Bellway's dividends to shareholders, with a plan is to distribute 1/3 of underlying after-tax profit. The interim payment last year was 35p a share, and an increase on that seems likely this time around, since analysts are looking for a full year payment of 131 pence against 117.5 pence a share last year. One further number to watch is whether the builder is setting aside further monies to cover possible costs associated with customer remediation and building safety issues that relate to cladding. Bellway has already taken provisions of a total cost of £165 million since 2017. I hope that you and your families are in good health and good spirits. Thank you for watching, and I look forward to seeing you again next week.